Ericsson just delivered the kind of quarter where profit collapsed, gross margins somehow stayed upright, and the stock still said absolutely not. So, yeah, this one's interesting. You're listening to Earnings Unscripted. It is April 17th, 2026, and we're looking at Ericsson's first quarter, the Swedish network equipment giant behind a lot of the world's 5G plumbing.
Yeah, and if you only read the bottom line, it looks rough. If you read the mechanics, it's actually pretty revealing. Sales fell hard, North America was softer, currency was ugly, restructuring blew up EBIT, and still they held reported gross margin at 47.2%. That part is honestly pretty disciplined.
Right. Revenue was 49.3 billion kroner, down from 69.3 in Q4. EBIT fell to 1.4 billion, from 11.2. Operating margin dropped to 2.9 from 16.1, and EPS went to 0.27 from 2.57. We don't have the street number in front of us, but the stock definitely had opinions.
It did. Pre-market was briefly optimistic. Then the regular session just erased that whole mood, and the shares finished down 7.15%, closing around $11.29 near the lows, which, after a pretty good run into earnings, is the market saying, fine, but this print was not clean enough.
Because the paradox are kind of wild, right? Gross margin held at 47.2, even with roughly a 7.8 billion kroner currency hit to sales. But underneath that, you had a 3.8 billion restructuring charge, a weird compensation hit from the share price moving up, and Enterprise still losing money. And yes, quick legal sip of water, this is not financial advice, just our personal opinions after too much coffee.
No, but that is the crux. Gross margin was the clean line. Almost everything else had noise in it. Currency, restructuring, even that 500 million krona reevaluation on cash-settled compensation. What I think management wants credit for is this. If North America is weaker for a quarter, they can lean harder into places like India and Japan and keep economics from cracking. That's an operational flex, not just a talking point.
Supply chain judo. Also, for anyone not living inside telecom acronyms, this is still mostly a company selling radio gear, software, and services to carriers building mobile networks. And that market is not exactly showering them with easy growth.
Exactly. Networks was still the engine, but softer. Cloud software and services dropped harder sequentially. Enterprise lost 1.4 billion kroner, which management flat out called unacceptable. And because the traditional RAN market is basically flattish, they're out hunting for new pockets of demand, network APIs, private networks, and some genuinely unusual defense-adjacent use cases.
Yeah, this is where boring telecom supplier suddenly becomes, drone catcher and military comms lab?
Pretty much. Ekholm was talking about 5G standalone with the Italian Navy and also using cellular network sensing to detect drones near places like sports arenas or critical infrastructure, which is kind of the perfect Ericsson anecdote right now. The old business is mature, so they're trying to prove the same tech stack can matter in new, more mission-critical settings.
And then there's the AI irony, which I kind of love in a dark way. Everybody else's AI and investors cheer. Ericsson says AI is making semiconductors more expensive for us.
Yes, yes, that is the hidden tax here. They are not the glamorous beneficiary of the AI boom. They're one of the companies getting squeezed by it on input costs. So you end up with this very odd quarter where the real achievement was holding gross margin steady, while the real anxiety is what happens later if chip costs keep rising and the restructuring savings take longer to show up.
So the sell-off is basically investors saying, okay, nice defense, now prove the second half?
More or less. They recognized a lot of pain now, said the cost savings really show up later in the year, and paired that with a buyback authorization of up to 15 billion kroner. That's confidence, maybe a little theater too. First impression then, ugly print, stronger execution than the EBIT line suggests, and a very real prove-it timeline from here.
Okay, let's get into that because I want to unpack how they kept the gross margin standing while the rest of the income statement looked, well, a lot less graceful.
Yeah, because the margin story is really about operational steering, not some magical demand rebound. Ekholm basically said, if we're a bit weaker in North America but stronger in another market for a quarter, we can actually compensate that and keep a very healthy gross margin. That's him telling you Ericsson still knows how to move mix around the chessboard.
So less miracle, more air traffic control. The plans are late, the weather's awful, and somehow nobody's crashing.
Exactly. Sales still fell. Gross profit dollars still fell. Sorry, gross income did. But the margin rate held because the business isn't one blob. They had softer North America, stronger pockets in India and Japan, and they kept deliveries on track even with the Red Sea disruptions forcing rerouting through their Middle East distribution setup. That is boring competence, but it matters.
Boring competence is maybe the most underrated line item in industrial Europe.
It usually is. And look, I don't read the flat gross margin as everything's fine. I read it as proof the core machine is resilient. Different claim. They can absorb a rough quarter without the economics fully cracking.
Right, because below that line, things absolutely did crack.
Yes, and that's the second layer. EBIT got crushed less by product weakness and more by cleanup costs. The restructuring charge jumped to 3.8 billion kroner, largely tied to headcount reductions in Sweden and parts of Europe. So Q1 is this awkward quarter where they take the pain up front. But management is also saying pretty openly, don't expect the savings to really show up in OPEX until the second half.
Which, I mean, every restructuring deck says some version of, trust us, the benefits are coming. Why should anyone believe this one?
Fair. I wouldn't believe it automatically either. What makes this one a bit more credible is they were unusually plain about the timing. Lars Sandström said restructuring charges for 2026 are expected to be at an elevated level, with a fairly large part already seen in Q1. And on the call, they basically said the savings help later, not next month. That's better than pretending Q2 suddenly gets beautiful.
So they're not hiding the bruise. They're circling it in red pen.
Right. Although one little tell I found interesting is they also cleaned up the labeling around adjusted metrics this quarter. They explicitly said it's a nomenclature change only, just excluding restructuring charges. Fine. But whenever a company spends extra time defining adjusted profit, it usually means the reported number is ugly enough that they need a second lens.
Investors hear adjusted and immediately pat their pockets.
They should. I mean, not because it's fake necessarily, but because it tells you where the pain is being relocated. And Ericsson had another weird relocation this quarter. The stock went up, which sounds nice, except their long-term variable comp is cash settled. So the higher share price meant about a 500 million krona negative revaluation hit to EBITDA. That's not dilution like US Tech SBC. It's more like, congratulations, your rally just created an expense.
Honestly, that is such a Scandinavian accounting plot twist. Great news, the shares worked. Bad news, now pay up.
Very elegant, very annoying. And when you stack that on top of restructuring, the income statement starts looking more dramatic than the operating reality probably was.
Okay, but this is where I get a little stuck. If Q1 was mostly a pain-clearing exercise, why does the story still feel fragile?
Because the next problem is arriving before the savings fully land. Ekholm said, we are facing increasing input costs, especially in semiconductors, caused in part by AI demand. Our ambition is to offset these challenges through product substitution and efficiency actions. That, to me, is the real test. Holding margin via geography and execution is one thing. Re-engineering around more expensive chips while you're also cutting people is harder.
Yeah, that's like renovating your kitchen while the price of lumber doubles and half the contractors just left.
Exactly. And telecom hardware doesn't get infinite pricing power. They can do substitution, squeeze efficiencies, optimize sourcing, all that. But if AI keeps vacuuming up semiconductor supply in the second half, then the savings from this quarter are kind of racing a new cost wave. So the clock matters.
So this wasn't really a growth story quarter at all. It was, what, a stress test of coordination?
That's a better frame. Yeah, a coordination test. Can they juggle regional mix, supply chain rerouting, layoffs, and chip cost pressure without letting networks' margins crack? If yes, then Q1 looks like an ugly reset. If no, then the flat gross margin we just praised turns out to have been the easy part.
Which is the mean version of earnings analysis, isn't it? Congrats on surviving the hard part. Unfortunately, the harder part is next.
Markets do have a cruel sense of timing. But that's why this quarter is more interesting than the headline suggests. It tells you Ericsson still has operating discipline, it does not yet prove the new cost base, and the future cost pressure can coexist comfortably.
Okay, so the real question from here isn't whether Q1 looked ugly. We know it did. It's whether they front-loaded enough pain and protected enough of the core to make the second half believable. So where does that leave the credibility test for the rest of 2026?
I think the credibility test is pretty simple now. Q2 does not need to be heroic, it just needs to look controlled. Management guided networks to roughly normal Q1 to Q2 seasonality and adjusted gross margin at 49 to 51%. So, okay, if they can hit that while restructuring stays elevated, the story starts to feel earned, not narrated.
Right, not redemption, just evidence.
Exactly. Because the bigger issue is Ericsson is no longer a company you buy for a booming RAN cycle. Management keeps framing that market as basically flattish over time. So the bull case shifts to execution, balance sheet strength, and whether these adjacent bets actually become businesses.
Which is a much less glamorous story, but maybe a healthier one. Less, the future has arrived, more, can you run an industrial machine without dropping bolts?
Yes, and to their credit, they do have room to try. Net cash is strong, they authorize that buyback, and they're not pretending AI is some instant revenue gift. Ekholm literally said, "We're not going to see any sales directly from data center expansions right now." I actually like that line because it's annoyingly sober.
Annoyingly sober is very Scandinavian CEO, honestly.
Yeah. But then comes the prove it part. Enterprise has to lose less money quarter by quarter. He called that 1.4 billion krona loss clearly unacceptable, which fair. And if semiconductor pressure worsens in the second half, investors will get less patient very fast.
So the outlook is basically competent core, limited room for fantasy, and a few very real checkpoints.
Yeah, that's it. If they execute, this quarter looks like an ugly bridge. If not, it was just expensive self-help.
That is bleakly elegant. All right, I think that's the Ericsson story for now. Thanks for hanging out with us.
Yeah, appreciate you listening.
If you want these earnings chats to just show up in your feed, you can follow the show. And just as an aside, this episode was AI assisted, but grounded in Ericsson's actual filing and earnings call transcript. So if you've got thoughts or a ticker you want us to dig into next, send us a note at earningsunscripted@datamadness.ca. And the X link is in the show notes too. Thanks for listening.